I'm Michael Fox, and this is the Prospector Podcast. And I have joining me, as he always does after the Fed meeting, I have Chris Temple, the National Investor. Welcome back, Chris.
Hey, how you doing, Mike?
I am doing well. The Fed meeting was almost a non-event this time around. Everything was so well telegraphed. I don't think there was a surprise amongst it.
Yeah, there wasn't going to be any rate move for sure. Nobody expected that. And of course, that was correct. We did see more of a stagflation prediction from the Fed, which was a little interesting, and I think maybe a little bit more so than some people thought. In fact, one of the commentators I heard immediately afterwards said that, well, the Fed, if you look at all their numbers, suggests we're going to go from stagflation light to stagflation moderate in the months immediately ahead, which I think is quite possible. They downgraded their assessment of what GDP growth is going to be. They took that down a few ticks. They raised their view of what core PCE is going to be. That now is back north of 3% to 3.1. They bumped up their unemployment rate forecast. But curiously, even though when you look at the numbers, it was a close call and a much more of a stark split than in their last dot plot in March, they still do, when you average out the extremes, have a call for a consensus of still 225 basis point rate cuts before 2025 is over. So that didn't change, came damn close to changing to a consensus of 1 instead of 2, but technically they're still at 2 right now. So bottom line is the Orange Wonder was clearly displeased about this. Ahead of the meeting, I quipped that, well, he called Jerome Powell several days ago a numbskull. And I said after the meeting, he's probably going to say something bad about Powell's mother when Powell doesn't show any more inclination to lower rates anytime soon. So
Actually, Powell got a bit of a upgrade from numbskull. Right afterwards, Trump referred to Powell as an idiot. So he's gone from numbskull up to an idiot. So he's been promoted.
Well, look, if the president wants to understand why the Fed cannot right now lower interest rates, a big part of the reason will be looking back at him from the mirror. Because here's a guy who has been all talk and no action when it comes to reducing the deficit or the debt. He has signed on to and tolerated the Republican leadership in Congress throwing away entirely his first, well, nearly all his first full fiscal year with the continuing resolution they passed earlier in the year. I've already said that people need to prepare themselves for another continuing resolution in September when they still don't have 12 separate spending bills close to being dealt with. And you're going to have a new fiscal year that's going to come into effect on the 1st of October. So as always, no shock to people who aren't afflicted with the Trump deification syndrome of TDS. The Republican leadership in Congress is no more likely now than they were under Biden when there was some Democrat leadership to do a damn thing to reduce the debt. And that's what the bond market is reckoning with. And the irony right now, Mike, where Powell is concerned, and here's a guy who is the single biggest person responsible for unleashing the inflation we had in the last few years in the first place, as I've explained many times, with all the money he printed with the excuse of COVID and then a looming financial crisis right before that, when you go all the way back to late 2019. But now he's in the place of being pretty much the only one with his finger in the dike, holding off a total rout in the Treasury bond market, because the bond market vigilantes who have kept long-term interest rates elevated, as you and I have talked about many times, the only one they see now that's even half serious about trying to keep some control over inflation and spending is this guy. And if Powell were to give in sooner rather than later, you don't want to see what's going to happen to the Treasury market. If that happens, we will very quickly exceed the highs that we've seen in this cycle.
Far be it for me to feel sorry for Powell, but I'm starting to feel sorry for Powell. You know, he's kind of trapped where he is by to do nothing. As you mentioned, the big beautiful bill calls for even larger government spending and larger deficits, which will be inflationary. So he needs to be able to fight that. Most people don't realize this, but with all the talk about tariffs, Trump's favorite word, very few of the tariffs have actually been enacted. He puts them on the books on one day, and within 48 hours, as they refer to him as Taco Trump, he chickens out and pulls them back. So, with the exception of a few things such as the steel and the aluminum tariffs, the tariffs on China, most of the tariffs that have been threatened haven't been enacted. So Powell is sitting here trying to decide if tariffs are going to be inflationary when they haven't been enacted, so he hasn't got data to support an argument one way or the other. We're in unfortunate times right now where you've got Iran and Israel firing missiles back and forth at each other. And we haven't seen the impact on oil prices of that melee yet. And as you know, energy is hugely inflationary. So, you know, there's
Well, and
three things there that could drive inflation way up. And, I got to think that the argument that there's even two rate cuts, not only would be off the table, but the dot plot would probably be suggesting rate increases.
well, they're not there yet, and I think if the pressure by Trump has accomplished even a little bit, and it arguably has, Powell has stopped, at least for now, talking about any possibility of actually the Fed moving higher again on the federal funds rate, which, if you remember, that was a possibility, though not the base case for sure, not all that long ago. So at least that has happened. And that's also a consequence of the headline inflation rates having drifted back down a little bit more. But you mentioned energy, which I want to talk about that and then talk about tariffs. Energy, Jeffrey Gundlach is a smart guy. He, with double line, he also believes that we are going to see higher long-term borrowing costs in the months ahead before the government is forced into some kind of new quantitative easing and or yield curve control, or a combination of the two, which is probably what it will be. We can talk about that a little bit more as far as the details if you like. But one of the things he pointed out in his own post FOMC comments yesterday afternoon is that every $10 sustained, just it doesn't, blip up and then a few days later fall back down. But every $10 move higher in the oil price that sticks equates to 0.4% increase in headline CPI. So we're already up about $15 off the bottom of the oil price, actually a little bit more than that. We're working on $20. It's 15, 16, whatever it is. $15 plus, let's say, off of the recent bottom in the oil price, which I think was artificially low and was from traders all being short, not because of the fundamental picture for oil being that bad. So we are inevitably going to get, over the balance of the year, a bump up in headline inflation again, number one. Number two, God forbid, me living in coastal Florida, we have a bad hurricane season, but more so if it's not here, if it's over in the Gulf area, and you get any sustained moves higher in oil or natural gas or both because of a bad hurricane season, that also puts renewed upward pressure. Plus, as Gundlach pointed out, the year over year differentials, you're dropping off a few extremely low inflation numbers from this time last year as you go to rolling 12-month year over year inflation. So that's going to cause the number to tick back up a little bit in the months immediately ahead also. So we've seen the best we're going to see as far as the inflation numbers are going to move back up. The Fed is correct about that. And the quandary that that's going to cause, and this segues into the tariff issue too, Mike, because a lot of people, myself included, think that tariffs will be, all else considered, also a wash. Because yes, you could potentially have higher prices in some respects, but that is going to be negated in some ways by less demand and by largely foreign suppliers of different things compelled to get rid of inventory, even if they've got to knock the price down. China is in full blown deflation. They've got to sell stuff at any price to clean the shelves. There was even a story this week, notwithstanding the present tariffs that are there, of European automakers knocking down some prices on cars exported to the US to make up in part for tariff imposition. So I'm not sure we're going to see a sustained increase in tariffs. And in any event, this is a subject for another day, and I'm going to be speaking and writing a lot about this summer, because the Fed, in the first place, shouldn't be focused on any of this stuff. If you had a proper monetary regime in this country, the Fed would be focused on monetary formulas. And if you think the long run inflation rate is 2%, then you target M1 and M2 for 2% increases, and that's what you hold monetary growth at. And if you had that as a first matter, we would not have the inflation problem we do today to begin with. And all of these other things would be addressed by fiscal policy or by economic policy. It was a mistake to begin with, and a tragic one, which we're going to feel more and more in the days ahead, that the Fed was allowed to print all the money that it's done and create all of these distortions, and now figure out, how do we put the toothpaste back in the tube and go back to sound money, which there is no way we go back to sound money if the Federal Reserve has a damn thing to do with running it. But again, that's a subject for another day. We've got to live with the mess that we have right now.
Yeah, and it's not getting any better. Now, you did mention yield curve, but let's before we go to that, let's talk about the actual inflation rate, because as you and I have spoken about, it's going to be very hard for Powell to raise interest rates much further than where they are right now. And given everything we've talked about that would indicate inflation is apt to go up, maybe not as harshly as I foresee it to be going, but it is going to be going up. I guess there is one capitulation that the Fed could make, which allows them to maintain interest rates rather than raise them, and that is to abandon the 2% target and treat it as a range of, X to Y, where it's kind of trading there now, like say 2.5 to 3.5, or 2 to 3% in inflation as being a target, and being able to maintain interest rates based on those. So, what are your thoughts on them capitulating that way?
Well, if you listen to Powell from yesterday and you simply read the headlines without coming out and saying it, they possibly just did that. And, after the decision came out, as I always, I've got CNBC on, to hear the initial decision, and then they get all their talking heads around there, and then they have Chairman Powell's press conference. And I didn't get to watch all the press conference. I looked at a few of the snippets later, but Steve Leisman, who is one of their main Fed reporters, he's always in the press conference afterwards, said, and I'm going to paraphrase his question that he rhetorically asked before even a press conference. And he said, does this basically tell us that there will be more tolerance from the Fed on higher inflation if they're still planning 2 rate cuts for 2025, despite increasing their forecast to 3.1% for PCE inflation? And of course, their PCE inflation number, as we all know or should know, underscores or understates what real world, consumer price increases actually are. So I did not get to see if he actually answered that question during the press conference. A couple of other things I read afterward, because I was on a couple of calls and I only taped the press conference. But I did read a couple anecdotes afterwards about the extent to which that came up. He just kind of danced around it. But it still begs the question, as you asked, if they're still showing the net consensus being two rate cuts in 2025, even as inflation goes up, then without coming right out and saying that, yes, they just said that they're going to tolerate higher inflation. Are they going to come out and say we formally changed our target to 3%? Hell no, not anytime soon, because then you're going to have a bigger rebellion from the bond market vigilantes saying, oh, now the Fed is running up the white flag. Okay, which they're going to do and have to do, and that's the course nature is going to take us on anyway. Okay, but they need to continue to use bombast and bullshit to bamboozle us all into thinking that they're still going to try and be at least somewhat firm on this. But anyway, that rambling answer to your question is that the Fed tacitly has already just done what you suggested.
Okay, that was actually brilliant. Have you ever thought of being a Fed head, Chris? Because that tap dancing was almost as good as some of the ones I've seen them do at these press conferences.
If they put me in charge of the Eccles building, I'd either bomb it or burn it to the ground and announce that we have no more central bank that's private. We're going to now have a national currency and a currency board. But you don't have to worry about that because I'm never going to be in that position.
No, no, of course not. Let's let's take a look at yield curve because that's another quiver that they have in their arrow they have in their quiver, so to speak, that they can put yield control into place to keep the long-term rates within a range. Because, as you say, the bond vigilantes are pushing really hard to push those out. So, what is yield curve control? How does it work? And what's the likelihood we're going to see it?
The likelihood we're going to see an attempt is a near certainty, Mike, in my opinion, coming from the Treasury or the Fed. It'll probably be a tag team effort. There's no question in my mind we're going to see it. You and I have talked about this before as a possibility looming somewhere off in the future. Now it's a little bit more urgent, especially when President Trump is upset that interest rates won't come down. He's the kind of guy who I would suspect has already told Scott Bessent, I want your game plan for how we do this on my desk. Okay, it wouldn't shock me at all if that's actually already happening behind the scenes. But what yield curve control is this. As things are presently and have been for some time, the Fed has the most obvious and overt control over short-term borrowing costs, the federal funds rate, the discount rate for the banking system, things like that. They do not directly set long-term market interest rates, which are set for the most part by the market. Now, you've got to put a big asterisk next to that because for a long time after the 2008 financial crisis, the Fed and the ECB and others joined what was already somewhat a yield curve control regimen that the Bank of Japan had been doing since the early 90s. And through quantitative easing and purchasing long-term treasuries, they kept the yield in the market artificially low by keeping the demand artificially high by newly printed money. Okay, so not only do they set the federal funds rate at 0 to 25 basis points, which it stayed at for a long time, but by announcing that we're going to buy X percentage, billions of dollars a month of long-term treasuries and then long-term mortgage-backed securities, that kept long-term rates in the market low as well, which, the argument was that keeps borrowing costs down. It helps people to get reflated in the banking system. It helps the economy to get back on its feet when borrowing costs are driven down and people are able to borrow money more cheaply and stuff like that. But that end game and people came to call that financial repression, where the whole world saw interest rates across the yield curve. They didn't call it yield curve control. It was quantitative easing with the excuse and explanation of this is what we need to help drive borrowing costs down and help the economy and markets get back on their feet. The consequence of that as we have all seen in different ways, is that that invited a lot of moral hazard, which you would not have had if the market was allowed to work freely. A lot of people were able to borrow money at rock bottom interest rates or refinance at rock bottom interest rates that it should never have been allowed to do that, including the federal government. Because the federal government gets stupid, just like individuals and private businesses can, when all of a sudden you think the borrowing costs are so low and so easy, everybody's going to borrow their way to prosperity. But at some point, the bills come due. And now the bills are coming due when the market has taken back some control of the long end of the Treasury curve in this particular case, because the Fed, at least for a while, said, okay, we overdid things. Let's start to reduce our balance sheet. Let the market work. We can let the market work for a while and see what happens. But now we're getting to the point where the market's working too well to suit the Fed and obviously to suit President Trump, who's all for free markets until he wants to take on more and more debt and has to pay for it. Now the markets are no good. So what comes next? All right, what comes next is overt yield curve control of some fashion, which I use the example of Japan, where everybody knows that for a long time Japan kept long-term interest rates, the 10-year Treasury for a while, and more recently before they lifted the lid on it, was pegged at 1%. And the way that the Bank of Japan did this, Mike, is that they didn't set a dollar or yen number per month of this is what we're going to buy. It's basically we're going to buy all the long-term bonds that we have to drive the yield down to 1%. Okay. Well, even in Japan, where for 20 plus years you had deflation entrenched, it no longer is, because even though Japan was more favorable for the Bank of Japan to do something like this, even that there now, inflation is rearing its head simply because of the accumulation of all the money printing. So now the Bank of Japan has had to back off and say, okay, we're going to spend less. Long-term yields have gone up. Actually, in Japan, in not many months' time, you had 30-year paper, I think it is in Japan, went from essentially nothing to now something like 3.5%, almost overnight. And that creates a new set of problems for people who have now got losses on paper on bond portfolios where they bought these bonds at low yields and now they're at a higher yield. And so that means you've lost principal, and it's a mess. So let me pause there and see if you've got a follow-up question, if this is making sense. I want to get too deep in the weeds before I get into what the Treasury and the Fed are likely to do.
No, that's making perfect sense. And
Okay.
we've started to see that yield curve in Japan unravel here in the last few months, where
Right.
there was a time where essentially Japanese bonds had no bid. And I guess that's the long-term danger of going to this kind of a strategy, is that just like any other strategy, eventually you have to pay the piper.
We have to pay the piper, and that's what the problem is going to be. So let me finish this dissertation now and talk specifically about what I see the Treasury and the Fed attempting to do and what the problem is. When Japan started their regimen of financial repression and yield curve control, there was essentially no inflation problem, number one. Number two, they were able to do almost all of this in-house. Japan's culture, their economy, their financial markets are all very homogenous, very insular. And so it was essentially and almost entirely, really, Japan financing Japan in this fashion. Okay. The US is not going to have quite that luxury because even though it is sometimes overstated, we still have many trillions of dollars of treasuries that are owned overseas. And we're going to have an increased need now for more foreign money to come in to finance all of these higher budget deficits that Trump has contemplated. Don't forget, folks, and I have arguments with my, and look, I support everything that President Trump pretty much says that he wants to do. The problem is he's doing the opposite of some of them, including with the budget. And I've had to straighten out more than once friends of mine recently who said, well, look, Trump is, the headline is that tariffs are going to bring in $2.8 billion over 10 years. His tax cuts will only cost an additional 3.6 trillion or whatever. And so you're quibbling over relatively small numbers. It's going to cancel itself out in the end. Plus he wants $1.6 trillion in reduction. I said, yeah, but here's the part you forget. That starts from a baseline assumption of adding $22 trillion more debt in the next 10 years. So they're starting at a place not from how their policies are going to impact the $37 trillion deficit today, but they're assuming that 10 years from now the deficit is going to be 58 trillion. So when you see these headlines, okay, of tariffs will do this, Medicaid cuts will do that, extending tax cuts will do this, it's off that base. And that's why his one big beautiful baseball, mega, hot dog, apple pie, motherhood, and the flag bill is running into trouble in the Senate and renewed trouble when it goes back to the House because people are starting to call bullshit on some of this stuff. Okay? And that's the problem that we're going to have is that the deficits are going to really start blowing out unless people get serious about cutting spending, which I don't see happening. And so when the point comes that the Treasury and the Fed get together and say, okay, whatever rigmarole regimen we come up with, we're going to peg the 10-year Treasury at 3.5%. Okay? Where the hell's all the money going to come from when the Fed at the same time is telling us that inflation is reaccelerating and the sheer volume of what needs to be sold is going to spike? Okay? So I see some major problems looming when you're trying to force down the throats of the markets and compel buying. And they could do this to some extent. I don't question that. You've got banks, you've got insurance companies, you've got other people that have to own certain amounts of treasuries. But it's not going to be enough. And they're going to have a real problem when they come back again and try and get the markets to choke down a 10-year treasury at a lower yield than it is right now, maybe substantially lower, when inflation is going to be newly accelerating and the sheer supply of debt, you're not going to have people want to buy it at that beyond those that have to. And then what do you do? So look, this is what a lot of people have warned was going to happen for a long time. We've seen shots across the bow with what's happened in Japan's bond market recently. It's simmered down a little bit, but the problem is still there. It's going to get worse. And look, what it's going to take in the markets is for the bond market vigilantes to say, okay, look, the U.S. is still the big fish in the world. It's still got the biggest capital markets. It's still got the reserve currency, but that reserve currency is going to get a whole lot cheaper. Inflation is going to get worse. And if you want us to keep financing it, fine. We'll finance the U.S. Treasuries until doomsday, but it's going to be at 6 or 7 or 8%. It ain't going to be at 3.5 or 4. And how Trump and his team are going to be able to compel the coming, and I don't question at all that the attempt is going to be made, how they're going to force everybody to accept new quantitative easing as it morphs into yield curve control, I'm really interested to see.
Yeah, well, it's going to be interesting because this conversation's all been about future debt. Let's take a look at the current debt. There's a couple of $1 trillion of current debt that needs to be refinanced, and refinanced if they go on the long end of the bond market at a much higher interest rate than they were borrowed at. Yield curve control isn't in place yet. So does the Fed or the government, when they go to refinance these bonds, go on the short end of things until they can put yield control in, or are they going to still have, take the hit on the larger interest rate on the long term?
Well, obviously, what should have happened a long time ago, and it's interesting and instructive that it didn't happen, and Janet Yellen was especially roundly criticized for this, was that when interest rates were rock bottom and you had the economy on its back and inflation was not an issue for a while, in the immediate aftermath of the 2008 financial crisis, you should have had the government at that time issuing all the long-term paper it could, but it didn't. Maybe behind the scenes it knew that it couldn't, and that there wasn't going to be the appetite for 30 or 40-year paper at sub 1% or something like that as it was back in those days. But now the situation we have is that, yeah, I mean, the 2-year treasuries, there's just a sliver under 4% right now. The 10-year is at 4.4%. I think inevitably we go to 5% or higher before this year is over, unless we have a major crisis. One of the things that I and others have pointed out, and for those that are on my mailing list, I put out a lot of information on this in just the last week or two, Mike. The fact, and this is sobering, the fact that several days ago you had the government of Israel start bombing Iran, and then Iran started to retaliate. The dollar rallied. Stocks had a minor hiccup down, most of which they've recovered as we're recording this. Gold popped, oil popped as it should, but treasuries managed to rally for about 2 hours overnight, and then as the day went on, the first full trading day after the war started, yields on the long end were rising. That should scare the hell out of everybody, because that's not supposed to happen, and you can't find a time going back several decades when you had bombs flying like this and worries over geopolitics, that you had the Treasury market not only totally unable to rally, but in the end sold off somewhat. And that tells you just how bad the situation is in the market, where nobody believes that the Trump administration / Republican Congress is going to succeed in slowing down the accumulation of debt, and that the Fed, as it just told us yesterday, has admitted that inflation, at least somewhat, is going to reaccelerate. And so that's what the bond market cares about right now. It is no longer the safe haven that it once was. And that spells trouble that I don't think Trump even has the mental ability to understand and accept. All he can do is whine publicly that interest rates won't come down. And like I said at the outset, look in the mirror and do something about it.
Yeah, in danger of sounding like a gold bug here, but we maybe have got to the point where treasuries aren't the safe haven that they once were, and the only safe haven out there is gold.
Well, and the other thing too, not to be doomsdayish about this, and Jeff Gundlach last week in an interview, not his post-Fed comments, but several days ago, was talking about this, that it's interesting to see that given that there is still pretty substantial liquidity in global markets, it's interesting to see the choices that investors are making right now, because you have had some embrace of corporate debt, at least the safer corporate debt out there. You have had some embrace, or more, maybe more so, an ability to hang on where even the stock market's concerned. Because given the path that we're on, you can paint the picture that Treasury, and this is what happened in the 70s. It's exactly what happened in the 70s. That Treasury bonds are going to be a piss poor place to have your money. You don't want to put your worst enemy's money in Treasury bonds. But if you still have at least some inflationary growth that's broad-based enough to keep everything plodding along, there are places in the corporate debt market that are worthwhile, that are actually better credit risks than the U.S. government. Likewise, elements of the stock market that are going to benefit from these policies. So that's where we're going. Now, for the fiscal picture, I don't know how long this will be tolerated because, if we see, if the government were to sit back, the Fed sits back, Treasury sits back, and lets nature take its course, then we see runaway rises in Treasury yields like we did in the 1970s. And back then, you didn't have the monstrosity of the government debt that we do today. So I don't think they can allow it to happen for an extended period of time. But if the market was allowed to do its thing, which it's been doing recently, that is the scenario that you get. Commodities do well. The stock market does less badly than some people might think, even if it just kind of marks time. But bringing up the rear is going to be the performance of U.S. Treasury bonds, which are going to be lousy as far as a total return vehicle, because there won't be any return. We'll be back to calling treasuries return-free risk instead of risk-free returns.
Yeah, none of this looks good, and that's why the Fed is stuck exactly where they are, doing nothing. Over the course of summer, I believe we have one more Fed meeting, and then it's s'mores in Jackson Hole, isn't it?
We have one more Fed meeting. I think it's the beginning of August, and we have the Jackson, Wyoming summer picnic that the Fed has every year. That'll be interesting as always to see what comes of that. And then, of course, we'll have the September Fed meeting after the Jackson, Wyoming picnic, and we'll see what happens between now and then. Right now, the Fed funds futures markets rallied a little bit in the immediate aftermath yesterday, but I think still we're going to go back to where we were before the meeting, that they look at a rate cut as early as September as a coin flip at best. And I think the odds are going to go down from there personally.
Yeah, well, I think we're going to see a lot of things that can happen between now and September that will be dictating to the Fed. This exchange between Iran and Israel is not likely to be done. So we'll have a clearer picture on oil prices. It's unlikely that the Senate's going to pass the big beautiful bill in time for the summer recess. So that's going to be sitting on the books unaccomplished going forward, and so on and so on and so on. So it could be an interesting summer that may dictate the course of action for the rest of the year, but we'll have to see.
Well,
If people,
this is gonna be, Mike, this is gonna be revealed. This one big, beautiful MAGA baseball, hot dogs, motherhood, and apple pie, and the flag bill, like I've derisively called it, is going to go down as perhaps, depending on how deeply he gets us into a new Middle East quagmire, which we don't know yet. But Trump sticking to his guns and insisting on this one overall piece of legislation is going to be revealed, and already is being revealed, as the most monumental blunder that is going to doom his economic policy, I am afraid. Even Rand Paul, who doesn't like a lot of what's going on in Washington, and properly so, has come out and said, as has Senator Ron Johnson, who's the head of the Senate Finance Committee, and properly taking a position against this one bill himself. They both said that if Trump in the first place had done what John Thune, the Senate Majority Leader, who I don't have any love for, he's a swamp creature like most of the rest of them are, but on this he was correct. He warned at the beginning, don't try and do all this in one bill because it's going to bog down. But like even Rand Paul said, if all you gave the Senate and the House was solely extend the 2017 tax cuts, make them permanent, so there's no, quote, tax hike that comes, and little else with it, it would long since have been passed and signed, and long since the House and Senate would have gotten to work to see how serious they're going to be about all the different spending things and cutting the budget. Okay? But Trump figured his bravado and bluster was going to force this all across the finish line, and it's not. So now the predicament is that the only way, and it's even too late to do this almost, and the Senate is warning about this, they're not going to meet a July 4th deadline to pass the bill in its existing form, even the Senate's existing form. If they did, they've now got new rebellions in the House, so they're not going to agree on this. All right. So even now, they can't separate out the tax cut extension and vote on it. They'd be smart if they did it, but I don't know if they're going to do it or not. So now you got the July 4th recess. Maybe Congress comes back for a while, but then everybody's worrying about the end of summer and the Labor Day recess. And now we've got little or nothing accomplished. It's the end of the fiscal year on September 30th. And that's when the speaker starts talking, well, gee, we did our best, but sorry, I'm like Lucy fooling Charlie Brown with a football yet again. We need to vote on another continuing resolution and kick the can down the road more and have many more months now of Biden post-COVID spending limits. Okay, do all of that, and then try and convince the bond market that yield curve control is okay. It's a shit show. All
Yeah.
right.
And then let's toss the other elephant into the room then. July the 9th. That's the day the 90-day hold on Trump's tariff policies comes off. Does he start to hammer everybody again? Apart from a bit of a letter of understanding that they're going to work on it between the UK and the United States, there has been no deals when it comes to trade and tariffs anywhere. And he says no deals, I'm going to put him back on. So, are we getting another round of Taco Tuesday with Trump on July the 9th and tariffs come back on or go back off or come back on? I can't remember which way the yo-yo's going on that one.
Nobody else can either. That's probably going to happen. They'll extend most of that again, I'm sure. He is. You can bet behind the scenes, getting at least a few adults. Besson's probably one of them. Telling them that, look, you're risking really a major debacle in the bond market, which could roll into the financial markets. We've got to stop the silliness at some point and actually accomplish something. Okay, and again, I always have to remind people, Mike, that I don't have either form of TDS. I don't have Trump derangement syndrome. I applaud a lot of what the president has done and has tried to do and is still trying to do. But I also don't have Trump deification syndrome. And I can look at these things that he's doing where the budget and everything is concerned and say, look, for his sake and the sake of the country, I don't want him to fail. But he has so screwed this whole thing up that I don't know if it can be saved right now. I hope I'm proven wrong.
Well, on that pessimistic note, if people could want to continue to follow your musings on everything, including how to invest into this quagmire, how would they do so, Chris?
Just go to nationalinvestor.com. There's the means to keep up with me on social media. Most important, if you're not already on at least my free mailing list, make sure you sign up. There's a lot of sector stuff I'm doing. And the good news is I have to say this, and I'm happy to provide the list to people who are serious. But on my recommended list, we are now up to 16 of my recommendations in the last 6 months that have doubled or more from where they were a year ago. And so there are ways to invest in this in a good way. I'm also going to give you a teaser. If you're out there in the audience and you've listened to Mike and or myself at all, you know how bullish I am on the uranium space. If you're not paying attention to what Sprott is doing right now with their physical uranium fund, you need to be paying attention.
Yes, definitely. Folks, I encourage you to follow Chris, encourage you to follow us with updated news, and Chris and I will, I'm sure we're going to have things to talk about between now and the next Fed meeting because the world is changing and changing rapidly. But thanks for your time today,
And a
Chris.
debt ceiling increase in the U.S. too. We left that out.
See, there's so many problems, Chris. We can't even count them all.
Never a dull moment.
Never a dull moment. Thanks very much again for your time, and I look forward to our next chat.
Absolutely. We'll talk soon. Thanks, Mike.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.